If I wanted to pay less tax in Australia in 2025 without doing anything unethical, dodgy, or against the law, these are the exact strategies I would implement. I'm Jacob Farmy, Client Director at the fastest growing accounting firm in Australia, Latitude Accountants. The first thing I would do is get my structure right. And there are two reasons I want to get my structure right. Number one, think about your structure as your default tax rate. i.e., if I did nothing else with my profits, this is the default tax rate that I would pay on my business profit. For example, if you're a sole trader, your default tax rate is going to be whatever the marginal tax brackets are going to be. And if you earn good money, that's going to be in excess of 45%. Whereas if you're a company, your default tax rate would be 25%. So any profits that you leave as a small business owner in your company will be taxed at 25%, so that you can immediately see there is a big discrepancy between what you might pay from taxes in a personal perspective versus if you were structured in a company and left your profits in a company perspective. The second thing your structure is going to do for you is open up opportunity to distribute money across your family group. So for example, if you have a family trust or a discretionary trust within your structure, that will give us the opportunity to do some tax planning and maximize where our dollars are going in the most tax efficient manner. In saying that, trust tax laws are always changing and you want to make sure you're still compliant with the relevant legislation. So I would recommend, if you do have a discretionary trust in your structure, speak to a professional who can guide you on that journey. Now, the advice I give to all of my clients when it comes to structuring is that number one, make sure you start with the end in mind and get your structure right on day one accordingly. And the reason for that is there can be unnecessary costs and even taxes involved in moving from structure to structure. So it is one of those things you want to pay the price and get right day one. The second thing I always say is that you shouldn't just start a company or a trust or whatever it is because Bob at the bar said that they've got this structure and that they're paying zero taxes. Number one, I'm pretty sure they're not paying zero taxes, and if they are, they're either doing something really dodgy or not making profit, which is not a position I want my clients to be in. So you need to make sure that you have a structure that fits you and your needs and not just Bob at the bar's needs. The final thing I always say to my clients is make sure you review your structure on a yearly basis. So every year I sit down with my clients and making sure that their structure is still fit for their business as it is and for their future growth potential and for their future plans. There's nothing worse than paying excessive accounting fees and having all these structures around you when you're not utilizing them and you're not really where you were when those structures were set up initially. The next thing I do if I want to make sure that I'm on top of my taxes is I would understand timing. When it comes to tax, timing is everything, and here's a quick example to demonstrate exactly what I mean. Let's say you have some shares and you made a profit on those shares. You held those shares for 11 months and then you decide, hey, I've made my money, it's time to cash out, and then you cash out of those shares and make a profit. If you waited an additional 30 days until you hold those shares for over 12 months, you would have been eligible for the 50% CGT discount, therefore minimizing the tax that you would have otherwise paid by simply waiting 30 days. Now, there is a commercial consideration. You don't want to hold those shares and make a bad financial decision just to save a bit of tax. But if you are around those timing cutoffs, for example, 11 months and 29 days, and it does make sense from both a financial and tax perspective to hold on for a little longer, then it might be a good thing to hold those shares and maximize your tax savings. Even further to this, let's say you held those shares and you also held other shares that were loss making, and you always wanted to sell these loss-making shares, but you've just never gotten around to that. Make sure every time you dispose of assets, you look down your asset holding portfolio and determine if there are any other assets that are making losses in the same financial year that you've always wanted to get rid of anyway, and you can dispose of those loss-making assets in the same time horizon you dispose of those gain-making assets and get those losses offset with those gains in order to put you in a better tax position. The third thing I do to make sure I'm in the best tax position possible is keep really good, accurate records. Now, there's a great mind and business owner that I want to talk to you about, and his name is the Notorious B.I.G. And then the 10 crack commandments, rule number 7 is keep your family and your business completely separated. And what Notorious B.I.G. is obviously trying to tell us is that you need to separate your business account and your personal account so that when you're looking at addressing any of your business expenses, they're not within your personal life. There's nothing worse than seeing a business owner who's convoluted all of their expenses in their personal bank account. And when I ask them, hey, what have you spent for work that year? They're trawling through their personal accounts or ripping out all the personal stuff and then trying to find the business stuff. Make sure you have a separate business account and personal account. So at any given moment, we can see instantly how much you've spent for the business, what those categories of expenses were, and we have records there to at least guide us to claim those tax deductions. Now, just on record keeping, having your bank statements is not always going to be enough to substantiate your claim. Obviously, the golden ticket is that receipt. So you want to make sure that you're keeping those receipts, whether it's in a Google Drive, Dropbox, or if you have an app like a Xero, you can connect other apps like a Receipt Bank or a HubDoc that store those receipts and even store those receipts in Xero for you. Also, the benefit of using a digital storing system is that receipts fade over time. So you want to make sure you've got good records, you've taken photos of them, and that way when it comes to substantiating your claim, you don't just come up with a faded piece of paper and you have those digital records available. The next thing I do is get an understanding of exactly what I can claim and what government incentives or benefits are around for any given year. I get asked millions of times, not millions, but a ton of times, what can I claim for my business or for my personal tax return? And I always refer back to these 3 golden rules. Number 1, you must have spent money and not been reimbursed for it. Number 2, there must be a sufficient nexus or connection between the expenses that you're putting out and the income that you are deriving. So it must make sense for you to earn this income, you need to spend this money. And number 3 is you must have that golden ticket or that substantiation, which is the receipt. For example, let's say you're a carpenter and you need a hammer at work in order to earn your assessable income. What you would do is make sure, hey, have I spent the money? Yes, I have. Do I have the receipt for it? Yes, I do. Is there a sufficient connection between the hammer and me earning my income? Absolutely. Therefore, that is tax deductible for you. Fun fact, there is even an industry guide the ATO puts out for most industries where you can actually see what everyone else in your industry is claiming, and I'll put a link to that even in the description in the information. In addition to knowing what you can generally claim, it's also important to know what government incentives are around each year. For example, in the current year, the instant asset write-off is $20,000. So any assets you buy for your business up to $20,000 are immediately deductible. If they're $20,001, you need to depreciate them over the life of the asset, and you're slowing down the timing of which you're getting that expense. So it's important you stay across that. That number changes every single year. Another example where it's important to know what initiatives were available is that in 2023 financial year, there was this thing called the Small Business Technology and Investment Boost, and most small businesses who spent money in digitizing their businesses were eligible for a 20% extra tax deduction. I won a lot of clients in that year, and every single time I picked them up from other accountants, I could always see that's the first thing I looked at, did they claim the extra 20%? And you would be shocked how many I've seen that have missed that 20% extra deduction for the small business owner. So it's really important that you're across the incentives that are available, but also, speaking of accountants, making sure you have a good accountant and trusted advisor on your side. Choosing the right accountant to go on that journey for you, and not just the cheapest option, is always going to be a great asset for you and your business. Now, I may be a little biased, but I highly recommend. It's one of the biggest decisions you'll make, and it could cost you or save you thousands and thousands of dollars in tax. Now, if you're unsure what to look for in an accountant, or if you're not sure if your current accountant is doing a good job, here are a bunch of things that I would be looking at. Number 1 is very simple. Do they get back to you? Are they responsive? And do they answer your calls? Think about an accountant as a speed dial, and before you transact, I need you to get in touch with your accountant. If you can't get a hold of them, weeks away from transacting, then you have a bit of an issue, because you're going into transactions and you're not quite understanding or being able to proactively plan for each transaction to make sure that you do it in the most tax efficient manner possible. The second thing I'd look at is, do they help simplify and make clear and concise all the different tax and accounting jargon? Warren Buffett says accounting is the language of business, but for most small business owners, it just looks like a bunch of hieroglyphics. So you want to make sure you have a good accountant or advisor who's able to decipher and clearly articulate the tax legislation that you might be impacted by. The next thing I'd look at is, are they an expert in the world that you operate in? So for example, does your accountant look after small businesses every single day, or are they more an individual tax return expert, or do they deal with large listed entities more often? Not only should they specialize in your world, but they should also be an expert. For example, are they a chartered accountant? Do they have great reviews? Have you been referred to them? And have they won awards in their industry to make sure that they're at the top of their game? That's the kind of accountant that I would want working for me. Finally, does your accountant keep you up to date with the latest tax changes? Because it's coming through thick and fast, and you want to make sure you have an accountant who's agile and making sure that you understand the various things that you need to be aware of, whether it's through social media posts, one-on-one calls, or just an email list where you're receiving regular updates. These are really important things to make sure that you're ahead of the curve, and these will save you thousands in tax, I can guarantee. Finally, last but certainly not least, one of the best things you can do for your business is do tax planning every single year. We've all heard the saying, if you fail to plan, you plan to fail, and tax is no different. Now, if you've never done tax planning, let me break it down for you so you understand the term. About April or May of each financial year, I will sit down with my business clients and I will have a look at the numbers and see where we're at before the end of the financial year. That helps us, A, determine what's our tax liability likely to be, and we would know that figure 12 months in advance, so we make sure we have that money set aside and my client is prepared for it, so they're not shocked when they hear the tax bill at tax time. The second thing we'd look at is if they are in a profitable position. Okay, here's our profit. What are some things we can do to put us in the best tax position, and how do we take action before the financial year is over, before it's too late? For example, your 30 June super will be due on the 28th of July in each year. But super, we know, is deductible when it's actually clearing, when it's A, paid, and then B, has already cleared the fund. So I advise my clients who have that super obligation in 28th of July, hey, have you thought about making that payment before the financial year and making sure it clears the fund, so that we can get the deduction for it 18 months in advance of when we actually would have if we pay it 28 days later. Another thing we do in tax planning is often review the family group and see where everyone's income is at. If our spouse, for example, maybe doesn't work, but we know we have dividends, but we know we have profits in our business, can we draw out dividends and make a distribution to our spouse in order to maximize their rate and use that money overall as a family group to further ourselves from a personal financial position? Just even in those two things I mentioned, you would be able to save thousands of tax and put yourself in the best position possible. And when you do tax planning, there's honestly 15, 20, 25 things that you can do. It's a decent meeting, and it's one that is bound to A, make sure you're prepared, and B, save you a ton of taxes. With all of those things being said, your goal in business is to make the biggest amount of profit possible, because that's why you got into business to start off with. And your goal should not always be focused around paying no tax. So there you have it. They're the 6 things I would do to reduce my taxes the legal way. I would structure right, I would understand timing, I would keep good records, I'd make sure I had an advisor that had my back, I would understand what I could claim, and I would do tax planning. Now, if you got value out of this video, I would love for you to drop it a like, subscribe, and share it with a friend. We're coming up with more tax, accounting, and business videos on a regular basis to keep you ahead of the curve, so we can't wait to see you in the next video.